So, life insurance for everyone. I decided we needed to go over this for our internal crew. A couple of different life insurance concepts here. Term life, whole life. Underneath whole life, we're going to break it down a little further and do final expense. And look, guys, there's going to be a billion different life insurance things on here. I'm just going to kind of hit the high notes. That's participating whole life. Let's see. Universal life. You got a guaranteed UL and an indexed UL. Of course, there's other types of ULs, but I'm just going to focus on those. So, pretty much everything that we would write would fall into some of these categories. Term life. Okay, so Johnny's question yesterday, he had a lady who had a term life expiring, and he goes to run an Ascendo final expense policy, notices that trying to get it to the closest value is way more expensive than that term was. Well, these are outrageous. Well, that's because term life policies have a term expiration on them. There's some kind of statistic out there that only 3% of term policies ever pay a death benefit. So it's huge profit margin because they're not paying. Normally you see them in a couple of different ways. There's 5-year renewable term that a couple of companies sell. Renewable.
No, you had it right the first time.
No, I didn't.
Just do cursive, they can never tell.
Renewable. I'm sorry I can't write as neat as Jordan Belfort, but I'll try. Then you got 10-year term. Then you got 15, 20, 30. That's pretty much it. Some of them do have what's called a return of premiums rider. Now on the term policies, the shorter the term, the cheaper the policy. So what we end up running into a lot of is like a 70-year-old who has a 20-year term expiring or a 10-year term expiring. And so when you buy a term policy, it should be made to know that on the expiration date, that expiration date of the policy, that you don't need the death benefit anymore. And if you're going to need continued death benefit past that, you need some sort of permanent policy in place earlier. You don't wait until the term expires. Because if I'm 50 and I take I go to term 4, the number 4, sale, SALE.com, and I run I'm super healthy and I get me a $100,000, term policy at 50 for 20 years, it ain't gonna cost that much. Because they think I'm gonna live to 70. I'm perfectly healthy, I'm 50. Most people are not dying before they hit 70. It's just not happening. Turn that down. So it's going to be really cheap. I don't know the price. It's not important, honestly. But when I wait until I'm 70 and I say, okay, well, now I need at least $25,000. That $25,000 final expense policy they then have to buy is going to cost more than that $100,000 term did. Because now they're 70.
Right.
And it's a guaranteed lifetime policy which is probably going to pay. It's going to pay something out one day. Even if they cash it out early, they're going to lose some money in it. Now they structure them to where they make money, but they have to charge a lot more on the premium. And if you really want to ever do the math on one, like when you ran one, what you should have done is this is what I tell people sometimes. If they're like, well, that's just way too much. Because when you're running into these people that are piss poor planners, they don't understand. And it's probably not their fault. I mean, they probably had a crappy agent that didn't tell them this stuff. But at the same time, like, they're not thinking about it. Most of them knew it was a term policy, and they just thought, well, I'll just get another term when I'm 70, and it'll be about the same price. So maybe $5 more. They don't know. It's ridiculously more because now they're 70. So when you're breaking down like that, and they're like, wow, that's way more. That's, let's say we're running a $25,000 whole life, and it's, 180 a month. You remember which one you ran? What the price about was?
It was like 180 a month.
Okay, about a $25,000 policy. Okay, so let's say it's 180 a month. They're 25,000, and they're 70 or whatever. So if you take that death benefit and you divide it by, say, 25,000 divided by 180, I would have to pay it 139 months. So divide that by 12. So they'd have to pay it almost 12 years for the company to break even on the policy. So that means they have to live and pay that premium for at least until they're at least 82 if they were 70 when they took it out, for the company to break even. So there is a decent chance that they're going to die in that. There's many more people die between 70 and 82 than they do 50 and 70. And life insurance is about risk. Companies trying to take calculated risk, and over the law of large numbers, they'll have more people that live past that, and they get to make money off of it, or make enough. So anyway, so that's how final expense policies are also. And then you also have to look at some benefits. Cody Askins has a great video on how he sells whole life. And it's not the whole sales picture, but what he talks about is once he gets the idea that somebody needs the life insurance and how much they need, then he starts breaking down like his 5 benefits. And he talks about cash value, rate lock. So it's never going up on the rate. He talks about it'll never expire. So you're selling things. So if somebody's coming off of a term, you're selling all these things that they didn't get before. And you're highlighting some of those things. And you keep doing trial closes in there. It's like, do you like the fact that your rate's never going to go up? Because this term policy, guarantee you that term policy, they could keep it and pay a higher rate, but the rate's probably like 10 times what it was going to be. And it'll start going up every year. Is this designed to force you to cancel? Our Paw had a term, and it came to the term when he was on his deathbed. So for about 6 months, they were having to pay $650 a month, and then the next month it'd be like $750, and the next month it'd be like $800. But it was like $116,000 benefit, so they had to pay it. But they got to where they were paying almost $1,000 a month towards the end. That starts eating into that death benefit pretty quick.
And not to get lost in the weeds, but on the term life, if you're in someone's home, if you will ask them to see their policy, and you turn to that page where it shows the illustration of benefits, it shows it going from $60 a month to like $600, and that helps you close the sale when you show them that.
Let me tell you, if you're going to people's houses, the one way that becomes more profitable than sitting on the phone and doing telesales is getting life insurance policies out. You're already in there and doing the Medicare, right? And so obviously there's I'm not saying go in there and door knock for Medicare Advantage and get the life insurance policies out and cross-sell them. I'm not saying that. But when you're building those relationships in the home and you're selling them a med sup rewrite or whatever the case may be, if you can sell them final expense, or you're getting out their universal life policies or their term policy, you're showing them stuff like that. You're showing them that their term policy is going to expire in 3 years and they're not going to be able to keep it. And the sooner they go ahead and cancel that crap and lock in their permanent policy, the cheaper rate they get. Plus, there's the protection of your current insurability. Same thing with the med sup. Somebody says, I don't want to rewrite my med sup right now to save $10. I'll wait till it goes up again. Might not be able to qualify next time. Then and the longer you have it, faster it goes up. Right now you have insurability. Let's protect your insurability by going ahead and getting you in a newer block of business that's not going to go up as fast. Yep. Same thing on life insurance. You got a term life guy. Well, I'll wait till it gets closer to term. I'm not going to worry about it right now. That's a little, it's less benefit. Well, we probably need to go ahead and get you in a permanent policy while you can qualify, because they still have health questions, and you can have a health question knock you out like that. You could be diagnosed with type 2 diabetes and given a metformin because you're pre-diabetic, or somebody can give you memantine because you're saying, my memory's a little foggy, or any stupid little thing that can cause you to lose your insurability. So you need to harp on protection of insurability. It's a sales principle, When you're selling Medicare Advantage, there's not a lot of salesmanship involved in it. But when you're talking about life insurance, you have to know what they're giving up by risking it. It's not election periods where you're like, well, I'll just get another Advantage plan next year if I don't like this one, or I have a guaranteed issue right, or whatever. You know, guaranteed issue rights on life insurance means it's going to cost way more, the benefit's going to suck. It's pretty much what it means. And there's not always a lot of them, and the commission sucks, and hard to get them to even pay. So not a benefit to that really. I mean, you know, well, we can talk about it later, but so the other ones you're going to run into, and I'll just harp on some of this really quick, is universal life. You're going to run into people who took out a universal life in the early 90s, late 80s, even later than that sometimes. And universal life, what it is it has a permanent element. It is a renewable term policy. It's typically, in its core, is a 1-year renewable term. But when it's originally sold, there are different premium amounts. There is a premium amount that if you pay that premium amount, which is a higher premium amount, they take the additional money and they put it into a cash value account where it has interest given to it in some way. Some of them had guaranteed issue or interest accounts. Like I have one on my mother that's supposed to have like a 4% guaranteed cash value account from the early 90s. But you had to overfund it because in the core of it, there's a cost for the death benefit, and that cost for the death benefit is going up every year, or every 2 years, or every 3 years, or whatever. It's going up over time. If you overfund it and that interest is bearing up an account, then eventually, years down the road, if the premium gets so high that it's over what you're paying, you can keep paying what you're paying, and they'll take the difference out of the cash value account. And what it does is it creates a permanent policy for less than it would typically be to buy a legitimate whole life policy with a locked in premium forever. Now, the problem with them is they were sold as a permanent life policy with a flexible premium. And what happens when you tell somebody that they can pay $18 instead of $60? They just pay the $18. Or what happens when somebody says, oh, you need new tires and you haven't saved any money? You can just take it out of that cash value account and they borrow against it. So then those universal lives a lot of times become pointless for them. They get to the point where they're just like a term and the price starts to go up so fast towards the end, they have no cash value in the account because they've been paying $18 a month for policy. Now they're 62 and the death benefit or the death benefit cost is $70 a month. Their cash value account gets wiped out and they're getting letters saying that it's not going to work anymore. And they're thinking, I had a whole life. It's just like when you sell somebody a Medicare Advantage plan and you tell them, I had a Medicare Advantage plan, this is a Medicare Advantage plan, this is a Medicare Advantage plan, this is a Medicare Advantage plan, and they call and they say, I got this AARP Medicare supplement, I don't even know how much it is. So sometimes, so this is why I don't demonize agents, because that happens to me after I explain it and call it the right thing. And somebody calls in and says, that agent told me I had a whole life and it would never go up. Did he? I don't know what he told you. But people typically don't know this stuff, so they're probably confused. It's probably not what happened. But you'll run into these universal life policies. They're running out of benefit, or maybe they haven't even gotten that letter yet. You're in the house and you say, well, you know, one of the things that we do, you know, besides Medicare, is we help people review their life insurance policies. Do you have your life insurance policy here? You know, and you can even tie it into the Medicare equation. When you're running kind of a needs analysis on Medicare and you're looking at Medicare supplement, I want Medicare Advantage, whatever, or they're already a customer or whatever, you're going back for a secondary visit, I need to make sure, you know, that you don't qualify for extra benefits, your Medicare savings programs or things like that. There are qualifications to see on here. What's your income? You know, do you have any retirement pensions, CDs? You know, do you have any cash value life insurance? You do have some cash value life. Do you have the policy? Now you're getting out the policy and you're getting to look at it. But you brought it into the equation of, do they qualify for extra help? Because extra help sometimes requires them to not have too much life insurance cash value around or too much CDs. So you can bring that into a regular equation and talk about, big picture stuff. Does that mean you're selling life insurance to Medicare Advantage? No, but it allows you to take a whole needs analysis so you can actually help them. And then if there is a need for that and you did sell the Advantage plan first, you could set up a secondary appointment and come back and talk about the life insurance or whatever. But there's a whole approach there, and you could pull out that life policy and you say, oh, okay, yeah, what you have here is a flexible premium life policy. And this flexible premium life policy is called a universal life policy. The problem with it is it wasn't necessarily a bad policy if it was explained to you correctly, is you had to overfund it. And it looks like you have about $363 in your cash account, but you're paying $18 a month like you've been forever, but your premium for the death benefit right now is $60 a month, so you only got like a year left before your policy's going to run out. And then you're going to have to start paying the $60, which if we look at the premium outlay, is going to be $72 the next year, $83 the next year, and then all of a sudden you're not going to be able to afford it. Well, your death benefit is this much. We could get this $363 out today, roll it in, get them to mail you that check for $363 and put you into a final expense policy where your rate will never go up. Now, it might be more than you've been paying this $18 here, but it's never going to go up. And this policy you got right here is going to be gone in a year. So it's not even, this fictional thing where you're paying $18 a month for your $100,000 death benefit isn't a thing anymore. You don't have it. So when the person calls you and they're like, I got this term, I need a new life policy, and you run a rate and you're like, this is way higher. That thing that they had is fictitious now. It doesn't exist. They can't keep it. You're not comparing it to that. It's like when somebody calls and they're like, I've got this drug plan and I haven't been paying anything, and you rerun it and a new drug plan's better. And they're like, no, I'll just keep the one the way it is. That's fictitious now. That drug plan that you had last year isn't working the same. I just ran it with all the new drug plans. If you keep that drug plan, it's going to be more than this WellCare drug plan or this Humana drug plan or whatever. If you keep this AARP plan, it's not going to be free for you anymore. They're changing their benefits. It's the same thing with that life policy. Oh, you're paying $20 a month for this term policy. Now this one's going to be $70 a month for final expense. Yeah, but this one's never going to go up. It's never going to expire. The death benefit's always going to be there. It's going to accrue some cash value. You're going to get a local agent that explained that to you. And it might be the hard truth, but I'm telling you the truth, and I'm going to fix this for you, in the long term. So you have to, sometimes you're having to sell that. It's not always cheaper. With Medicare, it's like, oh, we got a $200 med sup, and we're going to get you $100. And I might cross sell you dental for $34, but I'm still saving you, $66 a month. I'm saving you money. Life insurance is not always that way. Sometimes you're having to get people to pull out some more money. But do they need the benefit or do they not need the benefit? And you can put it to them like that. Do you need the benefit or not need the benefit? Well, some of those people are just going to say, well, I don't need the benefit because I don't want to pay for it. It's not that they don't need the benefit. They just don't want to pay for it. People are cheap. Screw my kids. Okay? They can sell my house and they can pay for my funeral and all that. You know how long it takes to get all that kind of stuff through probate? So how are you paying for a funeral in the interim? So a final expense policy is deemed to pay the final expenses. The payout on them, if you have a good company like Ascendo or Mutual of Omaha or Prosperity that's actually going to pay out very quickly, is quick. It's a final expense policy. It's a $10,000, $15,000, $20,000, $30,000 policy. It's very simplified underwriting. And it's made to pay out quick, money in hand to your heirs so that they can pay your final expenses while they're waiting 3 or 4 months for the house to be liquidated, to get money out of your savings accounts, all that kind of stuff. So final expense, even somebody that has a little bit of assets might need that in addition to it. It just frees things up faster. You can watch Cody's video on it, but when he talks about the final expense, he talks, one of those 5 benefits is something about it paying out much quicker while you're waiting on other stuff. So it's pretty cool. The other ones that, you get into life insurance, you get to some bigger stuff. So you're dealing with the senior market. That's kind of what I've been talking about. But you get into IULs or Index Universal Life. this is going to get into shiny object syndrome right now. In my opinion, at this point, for most of you, if you run into one of those, I would talk to Rob about it, or me. I'll try to help you with it. But these, index universal lives are, you can get yourself into trouble if you don't know what you're doing with them. I've only sold one, and it was to myself. And honestly, the more I learn about it, I think there are better ones out there. And I'm trying to learn more about which one's best just for me. But it's also a niche market that's harder to get into. You really got to go after a certain market. When you're going after a niche market, our niche market is senior communities, the Medicare beneficiaries. They know that we're good at that, right? Well, there's life products that go along with, their typical needs. And IUL is not one of them. Selling IULs to people over 65 is stupid. I don't know of a good solution. I mean, there might be some very rare occasion that it's a good solution that it wouldn't even be worth taking up your brain space to understand because it'd be so rare. So getting into that, if you get into it, it's a life insurance utilized as an investment vehicle sort of thing. And there's some tax advantages and all that kind of stuff. And whatever you think you know about it, you probably don't know that much about it because I've tried to learn a lot about it and it's confusing as hell.
Yes.
So the people that really know about that stuff focus on that. They focus on IULs and indexed funds and stuff like that. So you get into day trading and all that crap. I mean, that's a full-time job in itself. So IUL, term life, permanent, whole life. Participating whole life, I've all but seen that even be, I don't even think it's a real thing anymore. I'm not a big fan of the infinite banking concepts. It takes so long to get to the green on it that you're not actually paying for your car by borrowing from your life insurance policy until you've had it for like 17 years or something. So it doesn't really make a whole lot of sense to me. If I was going to do that, I'd be looking more at IULs. I'm very interested in this guy, Curtis Ray, that sent me that has this thing called the MPI concept where he can borrow money from take some spread in an IUL and invest it in call options and stuff like that. It's interesting stuff, but again, it's way out there in left field. If you were going to get into that, I would probably just pay one of those agents to take care of it for you because that's their specialty. You guys should be focusing on senior market, Medicare, health insurance, all that kind of stuff. So I think that is a good little rendition for the senior market side. So I'm going to leave it there, and then we'll get additional follow-up questions as they come. But that's kind of a macro level overview of the landscape of helping seniors with the life insurance equations that are going to come in. You're going to come into some policies that are really weird that you don't understand. And while when those come up, you have other people here that have seen them. Bring them to those people. Put it in Medicare Gurus. There's people on there that'll be able to help. There's some weird stuff out there, and there's weird names: 5-year renewable term, flexible premium, universal life. All those things are weird. There's one called a GULE, G-U-L-E. It's guaranteed universal life something. There's a whole lot of different names that different companies put on stuff. They typically fit into some sort of category like I was just talking about, but they don't have a name that makes it very confusing as to what they have. You may even run into somebody that had an index universal life from years ago, and they may not need to touch it. Sometimes you're going to find somebody with a life insurance policy, and you're like, this is good. Maybe find an additional need that it doesn't cover, even if you're leaving that one in place. Like I have an index universal life, I have a $2 million 20-year term, and I have a $1 million 30-year term. Those are different policies, but they fit different needs for me. It's not like everybody only needs one life policy. It depends on the person, what they're trying to cover, if they have mortgages left, if they need to cover the loss of their income if they die for their spouse. Social Security income protection. Do you know what happens when you have a husband and wife? One of them gets $800 a month from Social Security, one of them gets $2,000, and one of them dies? What happens to what if they were paying their bills into a household, paying for their house and their utilities and all that with the $2,800 a month? What happens when the one that was making $2,000 dies?
They only receive the higher benefit.
They receive the higher benefit. So the spouse, instead of getting $800, would get $2,000, but their income just went from $2,800 a month for the household down to $2,000. So life insurance sometimes has to make up for that loss of income. And maybe they didn't need it. Maybe they were so, they paid everything off and they've done so well, they saved a little money. Maybe they don't need that, but you know, maybe they do, or maybe they have a nest egg, but they don't want to dip into the nest egg because they want to leave that to kids. So they use a little final expense policy for $25,000 to help offset that loss of income. So a lot of different, you know, reasons that those policies are very, very effective for people and useful, and nothing more rewarding probably than when you sold somebody a life insurance policy and you get to deliver the benefit to, you know, the widow that really needs the money. So, all right, guys, life insurance.